What's good, guys? Welcome back to the channel. So I recently got a comment on one of my videos asking why invest in an ETF if it doesn't outperform the S&P 500. And of course the ETF could be anything, but I think the comment was in reference to JEPI or DIVO. Now I've said this before on the channel, but I view the total return as a spectrum. You could be on the price appreciation side, which is more risky, or the value and dividend side. But regardless of where you choose to be on the spectrum, the total return is still the number one most important thing. Now, the S&P 500 with a dividend yield of 1.35% is definitely a lot more on the price appreciation side of this spectrum. But still, the S&P 500 is a very low-cost passive index, market cap weighted, and it's viewed as a great proxy for the overall growth of the US economy. And that right there is why over long periods of time, it's very difficult to consistently outperform the S&P 500. However, there's still many reasons why you might want to invest in something besides this. And in this video, I want to go over a couple of the major ones. And if you guys enjoy the content, I'd appreciate a like on the video, even subscribing to the channel, leaving a nice comment. It's all greatly appreciated, but let's get started. Okay, so why not just buy the S&P 500? I have a couple of major reasons here. The first one is, don't go shopping for the chart that looks the best. And here's what I mean by that. So we all know the S&P 500 is very difficult to beat historically speaking. If we go ahead and add DIVO into this comparison, we can see the S&P has outperformed DIVO by a pretty healthy margin, although keep in mind this is not considering the dividend, and with DIVO that's a pretty major source of the return. But even so, considering the total return, the S&P has done a little bit better than DIVO over the past 5 years. But the key concept here is that these investments are more than a line on a chart. They have very different characteristics. So all because one line goes up and to the right higher than the other doesn't make it the best investment for you and your overall goals. You're not shopping for charts. If that was true, that means the ARK Innovation Fund here in blue would be the much better investment over the S&P 500 in yellow. Over the past 5 years, the ARK Fund has almost doubled the returns of the S&P 500. But I think we would all agree that the ARK Fund isn't better than the S&P 500 index. In fact, if we want to take this one step further, we can add Bitcoin. Over the past 5 years, Bitcoin is up over 4,000%. But of course, each of these investments are very different and aimed towards different people. So when investing, it's not all about which line goes up the most. The next point to have here is, what is your strategy? Because each investor has their own goals. So if you take a more basic approach to investing, and by the way, there's absolutely nothing wrong with this, and you have a portfolio that looks something like this, the QQQ to give you exposure to growth and tech names, and then the S&P 500 to give you exposure to the broad US equity market, this is a great, simple, and effective investing strategy. And in this case, for what you're trying to do, the S&P 500 is a fantastic investment. But there's a lot of different investing strategies out there, and you might have a more complex portfolio like this. So this half of the portfolio is QILD and TQQQ to try and give you exposure to some income as well as a high level of growth at the same time. And then on this side of the portfolio, we have covered calls as well as a closed-end fund. So you can see how in an approach like this, you have a very complex strategy, and the S&P 500 simply doesn't fit it that well. And speaking of fitting your strategy, the next point I have here is, how do you want the return? And this is in reference to the spectrum I was talking about in the beginning of the video. So in the past 1 year, the S&P 500 had a return of 10.9%. But if we come to the dividend tab over here, only 1.5% of that was returned to you in the form of direct cash dividend payments. Now that's pretty normal for the market. In fact, this kind of is the market, but some people might have different goals. Because if you want to live off of the yield of your investments or just build a second income stream, which might be the goal of some investors, it's going to be very hard to do that with a yield of 1.5%. So for people in this boat, DIVO might be a better investment. So the return is only 7.2%, which is a little bit less, but the much more reliable dividend yield is almost 5%, and it's paid out on a monthly basis. So if you're like me and you're trying to build up a second stream of passive income, this is going to be a much better vehicle to do that versus the S&P 500. And then my final point here is all the small details, and here's a list of a few of the major small details. And it begins with volatility level. So if we come back to this chart I showed in the beginning of the S&P 500 against the ARK Innovation Fund and Bitcoin, you're going to notice that the more volatile the asset is, the more price appreciation over the long term it tends to have. But the reality is, the vast majority of people never realize these high levels of return because of all this extreme volatility. As we're seeing currently with the ARK Innovation Fund, it dropped over 50%, and a lot of people are selling this at a huge loss. And this kind of price action with these volatile assets is not uncommon. But the reason why over long periods of time they do tend to outperform is because they have these windows of huge overperformance. But in my view, as well as most of the research, in order to fully reap the benefits of these huge periods of overperformance, you have to be invested for the long term and deal with this volatility. This volatility is the price you pay for these windows of huge overperformance. A lot of people try to trade in and out of these markets. They try to buy low, sell high, but the data shows that that's usually unsuccessful. You have to be committed for the long term if you want to realize all of these gains. And that same logic works in the other direction as well, with funds that underperform like Divo and JEPI. If you look at the past 6 months, Divo is up 5% and the market is up 1%. So it's held up a lot better during a lot of this recent volatility. We also have other options like closed-end funds, and these have their own set of unique benefits. This is BST, which is a very high-quality closed-end fund, and they have managed distributions. So if you're relying on this income to live, this can be a very nice feature. We also have things like fees to consider, and this is usually a downside of closed-end funds because they're actively managed. Automation is also pretty important. So Divo as the example here, on top of being a dividend ETF, the management of this fund also writes tactical covered calls on it to help boost the yield. And of course you could do this on your own, but it's pretty nice that this ETF automates the entire process of writing and selling covered calls. And finally, we have things like diversification to think about when picking different ETFs. I really like this tool for this purpose because this shows you the overlap between two different funds. So for example, if you invest in DIVB, this is an ETF for dividends and stock buybacks. It has a lot in common with the S&P 500, so there's kind of no point in investing in both. So even though the S&P 500 is a great proxy for the growth of the United States, there's other funds that also serve that same purpose. So there you have it, guys. Those are some of the major reasons why maybe the S&P 500 isn't the best investment for you. Now, of course, the S&P 500 is a classic index, and it's one of the hardest to outperform on a consistent basis. And if you follow the advice of Warren Buffett, for most people, this is probably your single best investment. But for the reasons I gave right here, there are some situations where you might want to consider other investments. That's going to do it for the video. Hope you guys enjoyed. If you did and you're still watching, I appreciate a like on the video. Go ahead and subscribe if you enjoyed, and I'll see you guys in the next one.